The US market has marked the biggest bull run on record. Prashant is here with some data crunching. Prashant.
Well, it's actually a pretty long and old bull market. Yesterday we sort of ticked past the point where this became the longest continuous unbroken bull market cycle in the US ever. I mean, the index that we're referring to is the biggest of the lot. S&P 500 is what we're looking at. And, the numbers are on your screen. I mean, the dates that you see at the bottom of the screen are essentially the beginning of this, a bull market, or maybe a bottom from a previous crash. So, for example, the last bar that you see, which is where we are right now, this particular rally began on the 9th of March 2009. And, we've not had a 20% drop ever since. I mean, since that March 2009 rally began, we've rallied now for 3,453 odd days or so, which gets us to yesterday. So, and we've, as I said, it was only yesterday that we've basically overtaken the previous longest rally, which was basically the 1990 to the Nasdaq sort of peak, which lasted 3,452 days. Now we are past that. And you can see the other sort of graphics on your screen as well, which tell you what else actually happened. In terms of the gains, this particular rally may already be the longest, but in terms of gains, it still lags behind the 1990 to 2000 rally, which led to about a 417% jump in the value of S&P 500. Whereas this time, we're up about 321%. So, I mean, it's lower as compared to the previous one, but nothing to be scoffed at. It's been a real big one-way kind of a move that we've had. Now, all kinds of debate is raging on whether the overwhelming evidence that there is a cycle overlay which plays on asset classes, equities included. We are already far along. Some believe into the last maybe a year or 2 years of this particular bull market. The absolute end is is nearly impossible to sort of call. But I think the evidence is kind of growing that maybe it's maybe far too along. But as they say, I mean, old age necessarily does not kill bull markets. It's something or the other. Maybe an accident, maybe higher inflation, maybe Fed hikes by more than what markets expect. We would only be wiser in hindsight as far as the reasons are concerned. But I think this is a pretty relevant kind of number to look at, pretty relevant data to kind of look at. Back to you.
All right, Prashant, thanks very much for that. In fact, let's say a quick